So let's continue along with our substantial economic effect problems. This is problem 3. Twizzlers General Partnership was formed several years ago when Strawberry and Cherry, calendar year individuals, contributed only cash to the business. The partnership agreement satisfies the 3 basic requirements of the economic effect test of Reg 1.704-1B to 2b. Twizzlers, among other assets, owns a portfolio of municipal bonds and corporate bonds with a variable rate of interest. At the beginning of last year, each investment had a value of $1,000 and each was expected to yield approximate income of $60. Twizzlers had net operating income from its business of $300 for the year. How will the tax-exempt and taxable interest be allocated to the partners if the partnership agreement provides the following? So we've got some different circumstances. We're going to go through each of those, but let's just understand what's going on here. So we've got 2 partners, Strawberry and Cherry. We can label those S and C, make it easier. They own a general partnership, equal owners. The partnership agreement satisfies the 3 basic requirements of the economic effect test. Now remember, we're looking at section 704B, substantial economic effect. And remember, we need to have substantiality and economic effect. We're told that economic effect is met because we meet the basic test of the economic effect test of Reg 1.704-1B to 2b, so that's met. So the question here deals with substantiality. So thinking back to previous problems, our chart's going through substantial economic effect. We've met the economic effect test. Next, we consider substantiality. That's what this problem is going to focus on. Now, this problem is meant to be a basic level overview of substantiality. There are more difficult issues out there, but this one is just a baseline example and some very basic concepts to help you understand. So the general partnership Twizzlers owns portfolio, so it owns municipal bond portfolio, and it also owns corporate bonds. They both have variable rates of interest. Now we're told that each investment had a value of $1,000 last year, expected to yield income of $60 each, so $120 total. And there's $300 of net income from the business for the year. The question focuses on the tax-exempt and taxable interest be allocated. So let's start with the first one. Let's call this number 1. Or you can call it A, whatever you want to do. First part of the problem. Strawberry and Cherry share equally in aggregate partnership income, which is the $300 of the net income. But Strawberry's share is deemed to consist first of interest on the municipal bonds. Assume that the bonds generate the expected amount of $60 each. Okay. So we have the $300 of business income, and that's going to be shared equally. But then we've got the $60 of interest each from the municipal bonds and corporate bonds. We're told that Strawberry, right, we can denote that as S, Strawberry's share is deemed to consist first of the interest of the municipal bonds. And then whatever's beyond that and with respect to Strawberry's 50% ownership comes from the corporate bonds. Okay? So the partnership will have income of $300 business income, right? That's that net income, plus $120 of investment income. That's the total 60 times 2. Because each bond, again, as we're told in the problem, expected of $60 of interest, $120 total. So we have, let's add those two together. We've got net income of $300. We've got the interest total of $120. There's $420 total to be split equally, okay? So that's going to be $210 between Strawberry and Cherry, S and C. Now, here's the issue. As you know, with partnerships on a K1, the characterization of the items makes a big difference in terms of separately stated items and whatnot, right? If you got municipal bond interest, that's going to flow through as Section 103, tax-exempt interest. If you got corporate bond interest, that's going to be taxable interest. So that makes a big difference in terms of the tax consequences. We're told in the problem that Strawberry's share is deemed of interest is deemed to come first out of the bonds, out of the municipal bonds. So we're saying, hey, the 210, that share, right? We break up the net income, 150, and the interest, we break up 60. We're told in the problem that Strawberry's share is deemed to come of interest is first going to come out of the municipal bonds, and then whatever of corporate bonds to make that up. But it just so happens this problem, they both get, or it's equal to 60 on both. So we're just going to break up the two between Strawberry and Cherry. Strawberry's going to take the $60 of municipal bond interest. Cherry gets the $60 of corporate bond interest because that's what the partnership agreement states. They're equal owners. It's the same amount, 60-60. So when you think about substantiality, there's transitory and shifting allocations. There's these different types of allocations. And one of the things that we always need to look at is the capital accounts. Because remember, substantial economic effect is all about tax must match book. Okay? Now, economic effect it really focuses on that, but substantiality does as well. And really the general gist of substantiality is you're looking at the capital accounts, the book capital accounts, and you're seeing if this allocation, this special allocation is changed, right? We're seeing what it would be without the special allocation versus what it is under the special allocation. If there is no change, that means it was done solely for a tax, or that means almost surely it was done solely for tax. You can refute that under parties' interest of partnership, but it won't stand substantiality. So let me explain in more depth. So we're going to have with the allocation, and the allocation here is a special allocation, and then without allocation. Without would just be what if we didn't have the special allocation. So we've got, again, we have Strawberry and Cherry, right? S and C. We've got the net income, right? So let's do without the allocation first. That one's easy. And let me erase some stuff here, give us some more room. Those numbers are still going to be important, so we'll come back to those in a moment. So we've got net income. We've got the tax-exempt interest. We've got the corporate interest. And then that's going to give us a total. So without the allocation, S versus C, right? Business income, this is all, or net income is going to be 150. That's across the board, right? We're not doing any special allocations there. That makes no difference with the special allocation versus without. The tax-exempt interest is what makes a difference. So if we didn't have any type of special allocation, so what I'm saying is that everything is just split 50-50. We have $60 total of tax-exempt interest, so we're going to split that 50-50, 30-30. Corporate interest is also 60, so it's 30-30 as well. That brings our balance down to 210 and 210 total. Let me give some more room here. Now let's do the special allocation. What happens here? So this is actually in the problem what we have, right? What's going on? Because we're checking that and we're seeing the difference. So with the special allocation, that's actually what we're told. That's where Strawberry's share of the interest is first deemed to come out of municipal bond interest. So we have 120 total. Their share is 50%. So Strawberry should be getting $60 of interest. So the first $60 that Strawberry gets should come out of the municipal bond interest. And then if we need more, we go to corporate bond. Well, it just so happens again that it's going to be all 60. Right, it's going to equal, and then Cherry gets 0, corporate interest, Strawberry gets 0 here, and 60. So we add those together, we get 210, 210. Now look, with the allocation versus without the allocation, these equal. If these equal, then this was not done from an economic standpoint. So substantiality is really affected. There is no reasonable possibility the allocation will affect the pre-tax amount in the partner's capital accounts. So this allocation clearly violates the general rule. The allocation is meaningless on a pre-tax basis. So the idea is that if there were differences in the capital accounts, based on the allocation. So like let's say you allocated especially just the depreciation, all of it to one partner rather than half, that would affect the capital accounts. But this one doesn't. It's equal. 210, 210, 210, 210. If it's equal, that creates an issue. So regardless of the amounts of income from either investment, Strawberry will end up with half of the aggregate. The only effect of the allocation is the tax character. So that's the only effect, is the tax character. So what I'm saying is compare. If you still don't understand, compare what would happen here, the tax. Let's say that both Strawberry and Cherry, let's say Strawberry is in a higher tax bracket. Let's say Strawberry is in an effective tax rate of 30%, Cherry is in a 20% tax rate. I'm just using numbers, whole numbers. So without the allocation, again, everything is just split equally. So Strawberry has tax-exempt interest of 30, Cherry has 30, corporate interest 30, Cherry 30, right? With the allocation, Strawberry has 60 tax-exempt and Cherry has 60 of corporate. So that means Strawberry pays no tax on this tax-exempt interest. Cherry pays all the tax on this $60 of corporate interest. And then since they're in different brackets, let's say where Strawberry is again in the 30% bracket, Cherry's in 20%, that would be a better situation than without the allocation because Strawberry's in a higher effective bracket. Overall, I'm using like an effective or average rate there, okay? Right, it'd be Strawberry, 30% of 30, that would be 9. 30% of 30 is 9. And then Cherry would be 20% of 30, which is 6. So 9 plus 6 is 15. Versus if Cherry had all 60 of the corporate interest, because that's what's taxable, right? This line. That's where I got those numbers, right? Strawberry, 30% of 30 is 9. And then 20% of 30 is 615. If Cherry has it, 20% of 60 is 15. I'm sorry, my apologies, 12. So this would result in 12 tax when you look at the things in total, and this would result in 15 tax. So the only thing that changes here is tax. So tax is only thing and book is not. So this is an example where substantiality really fails. So substantiality in number 1, it fails. Now, it still might be allocated this way under partner's interest in the partnership, but again, substantiality, we have an issue there. So this is an example of a shifting allocation. This is a shifting allocation in problem 1. And I want to mention, I said substantiality, it fails. There's still that presumption. The presumption can be overcome, and you can still get this to happen, this to occur, this allocation, right? You met economic effect, you still can overcome this, but the presumption it's not automatic. That's what I mean by it fails. So it's still possible, but it doesn't automatically, be substantial economic effect. There's an issue because, again, this is done for independent, just for tax. There's no book or economic benefit to this allocation. It's just done for tax reasons because we saw the capital accounts, the pre-tax capital accounts, they stay the same. So then we move on, and this one's going to be number 2. So we just dealt with number 1. Number 2, Strawberry and Cherry share equally in operating income, but the interest on municipal bonds is allocated solely to Strawberry, and the taxable interest is allocated solely to Cherry. Assume alternatively, the agreement on the allocation of interest is made before the beginning of the last year, and the municipal bonds and corporate bonds, in fact, earn $60 each of interest as expected. At the time the agreement is made, Strawberry and Cherry are both in the 40% marginal bracket, but Cherry has substantial investment interest carryovers under Section 163D. So number 1 was what we call a shifting allocation, because it all happens in the same tax year. Number 2 is also a shifting allocation. It's all within the same tax year. It's potential shifting allocation, say we haven't gone through and analyzed yet. So let me just first explain what's going on. So you might be looking at this number 2 and saying, isn't this the same as number 1? Well, number 1 was saying that everything is going to be split 50-50, but when it comes to the interest, Strawberry's share of interest will first come out of the municipal bond and then the rest out of corporate bond, depending on the circumstances. It just so happened that it was 60-60 in that year, but what if it was 40-80, right? 40-80, well, then you would do for all 40 plus 80 is 120, and then you would take half of that as 60. So strawberry would get 40 of tax exempt, which is all of it, and then 20 of corporate, and then cherry would get the remaining 60 of out of 80 of the corporate bonds. So that's what we're talking about. In this example, in number 2, it's saying that we're not going to do 50-50 anymore. We're just going to give the municipal bond interest, all of it to strawberry, and then the corporate bond, the taxable interest, all to cherry. Now, do these allocations, right? They're in the same brackets, but cherry has substantial investment interest carryovers. Okay, we'll talk about that in a moment. Do these allocations have economic effect? Well, yes, we're told in the problem. Are they substantial? Looking only at the general rule about how this works out, right? Strawberry gets all the municipal bond interest and cherry gets all the corporate bond interest. One might argue that so long as there's a reasonable possibility that the two investments will generate different amounts of income, the allocation should be respected. Now, this year at issue, it's 60-60, so it's the same, right? But what if it was municipal bond versus corporate bond? What if next year the municipal bond is 70 and the corporate bond is 80, right? Well, that would affect the capital accounts, right? If we go back to our capital account analysis like we did in number 1, well, strawberry and cherry would have different capital accounts. It would differ versus if you did, and again, when you're comparing, you're doing with the special allocation versus without. And the without special allocation, you would break everything 50-50, okay? And it'd be different because then you would have 70 so with special, you have 70 all allocated to strawberry, and then you'd have 80 of the corporate, right, all to cherry. And if you did 50-50, you add them together, you get 75-75, so that's a $5 differential. And that would affect the capital accounts. That would be substantial because that ends up having a difference, right, in the allocation. But this year it's 60-60. So if you do with the special and without, with the special allocation, right, this is the special allocation, right, we give all the municipal bond to strawberry and then all of the corporate bond to cherry. Without, we get the same situation as we have here in the capital accounts, right? If it's without allocation, it's 210-210. If it's with, we have 210-210. It's the same thing. They're equal. So, that means that from a capital standpoint, right, as it turns out, the pre-tax allocations are in fact the same as they would be in the absence of the allocation, right? The 60-60, right, with and without are equal. Since both of these allocations are made in the same year, they raise the possibility that they may be described as a shifting allocation or shifting tax consequences. The question is whether there's a strong likelihood the net effects on the capital accounts would not be significantly different from what they would be in the absence of the allocations, and that the tax liability of all partners collectively would be reduced. So it's two things. It's saying, first, are the capital accounts equal? Okay. And second, is there a change in the tax liability where one partner is affected versus another? Well, we saw in problem 1, right, strawberry was 30, cherry was 20, right, with and without, it was $12 of tax with the allocation total, 15 of without. So we know that the capital accounts are the same, right, so that's equal. What about the second? Well, in this situation right here, we're told that cherry has substantial investment interest carryovers. Let's say that, I don't give you a number, let's say that cherry has 100 of the substantial investment interest carryovers, right? They carried over from a previous year. Well, strawberry has 60 of tax exempt, right? And remember, the net income is equal, so we can hold that constant. Cherry has 60 of corporate interest, which is taxable, minus was 100 of carryovers. So what we're going to do is we're going to just go ahead and take 60 of that. We have 40 going forward, right? 40 carryover going forward. And what you see is that there's no interest that cherry is subject to. Versus if it was 50-50, strawberry would have 30 tax exempt, 30 corporate, which would be subject to a 40% rate, that'd be $12. And Cherry would have 30 tax exempt and 30, which would be offset. So it would be this situation with the allocations, no tax because Strawberry has tax exempt interest, so it's not taxable. Cherry has no tax because of the carryovers, the substantial investment interest carryovers offset it, right? So zero. But so that's with the special allocation. Without, we'd have $12 of tax because Strawberry would be subject to 30 of the corporate interest that would be allocated, right? 50-50. 30 of that, right? We break that 30-30 will be subject to a 40% tax rate, which is $12, and Cherry would have no tax because you'd have tax exempt and then offsets of carryovers. So that would create a change in tax liability. So the allocation does lower. It does indeed lower it. So that means that in this situation, this is not likely to be considered substantial. Again, it fails substantiality, but this is a presumption, so you can still overcome presumptions. Presumptions in tax land mean that the party that the presumption fails can still argue against it in their favor. Maybe there's some other reason why it's happened. Okay? So the last thing, and I'll call this number 3, but really it's a continuation of number 2. So same facts as number 2 with Strawberry being allocated all the municipal and Cherry being allocated all the taxable. What if Cherry had no investment interest carryover? However, during the year, Cherry incurred substantial investment interest expense. So this one would end up creating the same issue as it does in 2. So in 3, it's the same as 2 because it has kind of the same flavor, not exactly the same, but kind of the same flavor as number 2, right? You'd have the same capital accounts because, again, they're getting 60-60, and you break it up 30-30. It ended up being 210 and 210. So the capital account analysis would be the same. And then when you're looking at the tax effect without, Cherry would end up having some offset because Cherry has substantial investment interest expense that could lower that versus Strawberry doesn't have that, even though Cherry has it. The one thing I would mention is that with that substantiality failing the presumption would be more likely to be overcome here than it would be in 2. So it shows you how, again, this is kind of like a factors in a sense. If you fail substantiality, you can get closer and closer towards possibly still the allocation being respected. So again, just shows you how subjective this area is. That's all I want to do with this. The only other thing I want to mention is, so all these examples are shifting because they all involve the same tax year. A transitory allocation, let me change the font, the color on that. I just want to talk about transitory allocations. So I'm going to do that in blue. So a transitory allocation happens over multiple years. I'm just going to keep it basic. Let's say we have a partnership with 2 partners, A and B, and we're just going to talk about just general flavor income. Like, think of it like net income. Don't get into too much into the details. Just keep the concept. Transitory deals over multiple years. So let's say, based on the partnership agreement, in years 1 through 3, partner A is going to be allocated all the tax exempt income of the partnership, and then B is allocated all the taxable income. And again, we're just thinking of this as like just broad Section 61 ordinary gross income. And maybe there's some special rule that provides some of their income as tax exempt. And then years 4 and 5, it's going to switch. So usually there's a switch at some point. Or maybe rates change at some point, right? Or there's a special offsetting NOL, which I'm going to show you. So in years 4 through 5, A now gets the taxable income and B gets the tax exempt. And if we look more in the facts, let's say that B has expiring NOLs to use by year 3. So this would be a transitory. The idea is that, okay, well, let's say everything is split 50-50 still. Let's say A and B are 50-50 owners, and they still divvy up the income the same, but they have it broken so that A gets more tax exempt in years 1 through 3 than B does, and B gets more taxable income because B can offset more of the NOLs. and then for years 4 and 5, it switches over. A gets more taxable, B gets more tax exempt. And again, it's to take advantage of B's NOLs. That would be considered a transitory allocation, which would lack substantiality. Again, you can try to overcome that through the presumption I talked about, where you have to prove for certain reasons. Again, more subjective. We saw that continuum earlier I talked about. But the idea is that this is not a hard, fast area, substantiality. When I teach partnership tax, I generally don't test this. Economic effect is much more mechanical. Substantiality is much more subjective. It's just, if you're probably taking a partnership tax class, more of a early partnership tax class, not like an advanced class, your teacher or professor or whoever, they just want you to spot when these issues come up. Shifting allocations, transitory, and usually what you focus on are these two things. You focus on the capital accounts. Are they the same with the allocation or without, right? And we saw that. And then change in tax liability, does it go down due to the special allocation? If you see both of those, you definitely need to note that. And if it's within the same year, it's okay, the same rates in the same year or whatnot, that's considered a shifting allocation. If it's over multiple years, that's considered transitory. And then again, you can still overcome that failure of substantiality to still make the allocation be respected. But again, you have to overcome that presumption. All right, so I hope you enjoyed this. Again, meant to be a basic discussion of substantiality. When we go through substantial economic effect, we really focus on the economic effect element, which is in the other problems, in the other discussion. But really, this is just meant to hash out substantiality and these items.